This slide, I think, does a great job of putting stock market volatility into perspective. We just showed you a picture of stocks in the red. So this one shows us that stocks are often in the red, right? The gray bars show us calendar year returns for the S&P 500 going back 40 years, right? Over that time, 32 out of the 42 years on the page, the S&P finished the year in positive territory. That being said, the red dots show you the intra-year declines in each of those calendar years. So despite such positive returns from stocks, we always have to be ready for a pullback. In some cases, 20% or 30%, or you see that big one towards the right side of the page, down 49%. Now that turned out to not be a great year for stocks, but there are some years where we had big declines, and most of the time we still end up in positive territory.
There's a clear indication that as whatever transpires going forward here, that negative 38% was then followed by many quality years in the stock market. So those that got really nervous, and this goes back to investor behavior and not having all those elements, the plan, whether it's investment, financial, cash flow, people that got out of the market at that time and then were waiting for a signal to get back in. At what point did you do it there? And there's a good chance that a lot of people missed out on the 23%, maybe 13%, and future years' returns. So just wanted to point that out again, that there's the intra-year declines, but then at the same rate, we're looking for long-term here. So if you can stay with a long-term investment strategy, it's typically going to provide you better outcomes than trying to time the market.
Absolutely. I think it'd be appropriate to close, once again with a reminder. This slide is really meant to help keep our focus on what matters and focus on what we could control. And while they all are always relevant, I think maybe the second bullet point is most relevant. Bob already mentioned that we really are here to concentrate on your long-term goals and objectives. We talk about what happened over the course of a quarter just to gain and help create understanding about economics and how it weaves in with our investments. But it's really always about our long-term goals and objectives.
Yeah, Mario, it's paramount that everyone just stay in their seats. Try not to turn on the news and believe that what you're reading or listening to is prognostication of the future. Remember, the stock market goes up about 66, 67% of the time. We're a resilient bunch. We typically find new and ingenious ways to continue to expand the economy and grow. So there's going to be bumps in the road along the way. And that's where there's opportunities to diversify and rebalance and raise cash or whatever needs to happen, but not necessarily change your overall investment philosophy based on what's occurring in the markets. So that's it.